This is AI Finance Daily. Most people are getting this wrong. Today, we fix that. The subject: software margins used to be 80%. AI companies get 40%. Here's what that means. Margins. Once heralded as the holy grail of software companies, margins for traditional software businesses often floated around 80%. This monumental figure shaped investor expectations and valuations for years. But here's the disruption brewing beneath the surface. Artificial intelligence is challenging this paradigm. AI companies, on average, are generating margins closer to 40%. Now, why is this happening? It's simple yet profound. AI is fundamentally a replacement for human labor, and labor wasn't where those high margins came from in the first place. Traditional software's profitability thrived on low marginal costs after development. Every unit sold after that cost virtually nothing to produce. But AI technologies, particularly in fields like machine learning and generative AI, don't replicate this dynamic. Instead, they demand substantial capital for training data, computational power, and maintenance. This creates a scenario where operational costs are significantly higher than what we've historically seen. Here's why this matters to you specifically. If you are an investor betting on software as a service or SaaS models, you must rethink the valuations. The golden days of 80% margins are over, might never return, and could lead to a massive recalibration of the market. The implications are profound. One needs to contemplate how different companies will adjust. Companies like OpenAI and Midjourney may never achieve previously standard margins in the software realm. Rather than investing in high-flying stocks based on obsolete margin expectations, one must identify which companies can adapt or innovate effectively in this evolving landscape. This is where the conventional wisdom breaks. Many are still banking on the idea that AI is simply an extension of software. It's not. Much like the historical shift from the industrial age to the digital age, we are in a moment of radical transformation, essentially a new paradigm shift. The number everyone missed is AI's impact on labor markets. A McKinsey report suggests that by 2030, up to 300 million jobs globally could be impacted by AI automation. Firms that historically enjoyed high labor margins will now face a formidable challenge to justify their profitability. What does this mean for your portfolio? As we enter this new epoch, there's a compelling case to reallocate capital towards firms that are positioned to benefit from AI's efficiencies, rather than stuck in the high-margin expectations of software's past. Look at companies embracing AI and transforming their business models around these new realities. Those that see the potential and adapt could yield returns that traditional models will not. Conversely, sticking with legacy firms that haven't adjusted, you may find yourself holding assets subject to heavy inflation and value erosion. This opens the floor to a sobering truth. Every dollar not deployed in AI adaptive assets is being confiscated by the creeping specter of obsolescence. The personal implication here couldn't be clearer. For those of you managing portfolios or retirement funds, the mission is now crystal. Move with agility or risk falling behind. Pay attention to earnings calls, and watch for signs of innovation or strategic pivoting that capitalizes on AI's lower margin realities. Some may argue that tech giants like Microsoft and Google are positioned to weather this storm due to their scale and resources. There's merit in this. They have the capital to invest in AI while managing traditional revenue. Yet, even these firms face the fundamental question: can they genuinely extract the value in the new paradigm? If you remember nothing else from this episode, the historical parallel here is the transition from manufacturing to a service economy. We saw valuations of manufacturers decline as automation took hold. The fast followers redefined themselves. Those left behind struggled, leading to catastrophic losses. As an investor, you must ponder whether your assets are among the innovators or the innocents caught in a whirlwind of change. Allocate wisely as the narrative continues to unfold. The wealth transfer you're witnessing is a dynamic, ongoing story, one driven by how we adapt technology to improve efficiencies. In closing, one scenario is that today's AI companies reshape not only their profit margins, but the entire landscape of financial expectations. Embrace this knowledge, or like the legacies in the last shift, watch your assets lose their glow. The future is your choice. Will you seize it? That wraps up AI Finance Daily. One small ask: if this was useful, hit follow. It costs you nothing, and it means we can keep making this